What's up, guys? Welcome back. About a month ago, I made videos on how to sell a covered call as well as a cash covered put. The videos got some amazing feedback. They seem to really help people, especially in these beginner stages. But there was some frequently asked questions that keep getting asked literally on a daily basis up until today. So I figured today would be a great opportunity to go through. I scrolled through the comments of each one of those videos. I picked out about 10 of the most frequently asked questions. What I'm going to do is I'm going to read those questions. I'll timestamp them in the description below so you could jump right to a question that you might have. And then at the end of the video, we're going to dive right into Robinhood. It's Monday. The market's just open. I'm about to make some covered calls and some cash covered puts as well. So you could see exactly how I do that and the thought process when I'm making those options trades. So I'm looking at these questions now. I think the most common question I get is, how do you close a covered call or a cash covered put? I'm definitely going to talk about that. How long do I do expirations for? So how far out do I make my options? I'll definitely talk about that. Other option strategies, people have been asking me, will I do other option strategies? I'll just answer that right now. I will be doing other option strategies, just not quite yet. I want to make sure I know exactly what I'm talking about before I come on here and tell you so that there are no mistakes. And I don't want to get anybody into any financial trouble by speaking out of pocket. So other strategies are coming soon. I am doing other strategies, but we'll get to those. People that are real beginners ask me if you can sell your covered call option. I'm not really sure what that question means, but I think I am. I'll get to that. On Robinhood, as far as when you receive premiums, I get questions all the time about when do you actually receive your premium? It's not showing in my portfolio value. I'm going to explain to you exactly why you don't see your premiums right away in your portfolio value, but you did receive those premiums immediately. I'll talk about those. I'll show you where you can start trading options right here on Robinhood without, because some people don't have that trading options. You have to enable it. I'll show you how to do that. People ask how I get an option fulfilled quicker. So people are placing these options, but they're not getting filled. I'll talk about the bid ask price and pretty much tell you how you can get your option fulfilled pretty much immediately. What happens to your contract if it hits the strike price before expiration? This is a comment I see all the time. I'll tell you some things that have happened to me when it's hitting the strike before expiration. People are always asking me how I choose a strike. At the end of the video, when I go in and show you my covered calls and my cash covered puts, I'll tell you how I choose my strike price. In the options chain on Robinhood, the premiums show in green and red, and people ask like what that means. I'll talk about that briefly when we're inside Robinhood. And what happens to your contracts and your dividends as you approach the ex-dividend date, and if you're in a contract during the dividend date. So the first one, let's dive into Robinhood. Right now I have two options open. I have a Wells Fargo call that's expiring this week, as well as an Aflac call that is expiring this week. So the first thing I want to do, what happens if I want to close that option? So what I'm going to do is I'm going to click on Wells Fargo, for example. Now on the desktop version, it's easiest to do this because we see at the top, there is a buy to close and there is a sell to open option. Now on your app, that option isn't there. So you kind of have to know what you're doing. And essentially you'll be doing exactly what's happening here. The desktop just makes it a little bit easier to do. Now, when might you want to do this? Well, I've seen two circumstances where you might want to do this. Number one, if you have a cash covered put and the price for whatever reason is just diving, it's just going down, and you're taking losses and you're going to have to buy these shares at a price that's way above what it's currently valued. You can go in and buy to close that cash covered put, and that will close a trade and you will mitigate your losses. Now, when you buy to close a sell option, you have to supply the premium. So for example, if you received a $15 premium when you sold the option, well, when you buy the option, if you have to put up a $15 premium, you'll break even. But if you have to put up a bigger premium to close it, then you'll take a loss on that. So for example, if you had to put up a $20 premium to buy to close, you would lose $5. And you see how that works. But sometimes losing $5 is a lot more than losing a ton of capital gains. The opposite would be if you wanted to close on a covered call. If for whatever reason the share price is just going up, and you're going to be forced to get your option called away and your shares called away, you might want to close that particular option then. I very rarely do it. It happens sometimes. The other reason that I might do it is if I have a longer term expiration and the value of that contract has gone down, and I'll talk about that value, where the premium is really next to nothing to close it out, then I can get my collateral back and reopen a new option that's closer to the share price and get a higher premium once again. But generally, I'll only do that when I have a long-term expiration. So essentially, I would just click buy to close, and then you'd buy to close and you'd put this in here. And right now, the buy to close is at $14. I got $13 premium, so I would lose $1 on this, but I would get a wash and I would no longer have to worry about that. When you do close an option and you go back to your home screen, they will not show up on here anymore. And that's pretty much it. Like I said, I very rarely do it, but you can do that to mitigate losses on the downside. And also if it's shooting up on the other side, or if you want to get rid of it just to clear it, get your collateral back and make another trade. While I have this screen open, I want to talk about when you receive premiums and why it's not showing up in your portfolio value immediately when you keep hearing that you get these premiums immediately. Guys, as soon as this is fulfilled, you get this premium in your buying power. Now, if you want to prove that to yourself, if you go to your account and you look at orders, inside those orders, you will see those right here. So you got those premiums right away, but it does not automatically reflect your portfolio value. And here's what I mean by that. Let's just say that my portfolio was valued at $11,000, just for round numbers. And I sold an option and I got a $15 premium. My portfolio value here would not go up to $11,015. And here's why. During the time till expiration, your particular option has a value, and you see the market value here. And what that means is what the premiums are doing according to the premium that you sold. So for example, right now, I got $13 premium. But if I was going to open one right now, I could probably get $14. So from when I got my premium to what it is now, I've essentially lost $1. Now, I haven't really lost $1. It's just what I could have done if I would have waited 30 minutes longer or whatever, and I would have got my premium right now. But what that's going to do is that's going to fluctuate throughout the entire week. The options value, that is what reflects your portfolio value right now in real time. So the premium does, because what if you were to buy to close? So it keeps the value of that option reflecting your portfolio value throughout the entire time until expiration. When expiration hits, then that premium will reflect your portfolio value because the option will either expire worthless or you'll get called away shares or you'll be forced to buy shares. Then we can see a realistic portfolio value after expiration. But don't worry, you receive that premium right away, but it does not reflect your portfolio value because the value of that contract changes and fluctuates until expiration. Another quick answer to a premiums question. If it does get assigned, yes, you keep your premiums. Once you get that premium, it is yours forever. Nobody can take it away from you. The next question I want to answer is, how do you get your option fulfilled a little bit quicker? As you can see right now, I've placed an option for AT&T. It is a covered call at $30.50 for a strike price, and it has not been filled yet, and here's why. Here's what I'm going to show you. If we go to trade options, if you do not see this trade options right here, all you have to do is go into your account and enable it. So I'm going to click account. I'm going to come down to settings. I'm going to come over here to options trading. Right now I have this level, level 2, and you can change your options and allow those to happen. The things I'm doing are very basic. They're going to ask you a couple questions. Make sure you know what you're doing to protect yourself, and then you'll be able to do your options trading. So inside this options chain, here's where I'm going to answer a bunch of different questions. First and foremost, make sure you're on the sell tab, and then you're going to either be on the call side if you're using your 100 shares as collateral, or you'll be on the put side if you're using cash as collateral to cover the purchase of those 100 shares. The first thing we're going to look at is on the left, and that is going to be the strike price. The strike price is going to be the price at which you will be assigned, or the contract will expire worthless if the share price does not reach that. So on the call side right now, I have a strike of $30.50. That will receive a 5-cent premium per share. Now a contract is 100 shares, so that'd be a $5 premium. As you go further away from the share price, the premium that you'll receive tends to go down. Now people ask, well, these are so high down here. Yeah, well, that's because you're going to be paying a price for those 100 shares, which is less than the current share price. Now, if you think it's going to dive by Friday or whenever your expiration is, go for it. How I choose my strike price is I use my current cost basis, like how much money have I invested? Because if it gets called away, I don't want to take a capital gains loss. Right now, $30.50 is above my basis. So I'll take that $5. Also, you have to look at the volatility of the stock. Right now, AT&T, I know it very well. It pretty much fluctuates between $29.50 and $30.50. It hasn't really gone above those thresholds in a long time. So I'm very comfortable that, $30.50, I could get assigned. It doesn't matter. When you make an options trade, especially a covered call, you must assume that it's going to get assigned. And then if it doesn't, it expires worthless, bonus will do it again. But don't do this with shares that you are married to that you do not want called away. So if I was going to put a put against this, meaning I wanted to possibly buy 100 shares more, I would put a put on it. Now the premiums are going to lower. This is if you think the share price isn't going to go down. So if you think it's going to go up and you want these to expire worthless, right here, I would choose a $29 strike. I would receive a $4 premium. If the share price does not dip below $29 on expiration, it would expire worthless. I'd keep my premium and I would do it again. If it did dip below $29 at expiration, I would be forced to buy 100 shares at $29 per share, or for $2,900, $2,900, and those shares would be mine. Back to this call that I'm actually placing, how do I choose an expiration? Generally for me, I go 1 to 2 weeks. Very rarely do I go 3 weeks, mostly because a lot can happen in 3 weeks. So what I will generally do is I'll look at the strike that I want, $30.50. I'm going to get $5 for that. I'm going to look 1 more week out, and if I don't get at least double that, then I'm not going to go with 2 weeks. So if this is trading in 2 weeks at $8, I'm going to go with the 1 week and then maybe get 5 more and get 10 over 2 weeks instead of 8. But if I look 2 weeks out and it's say $12, I might consider doing a 2-week option. Let's take a look and see. For September 4th, which is 2 weeks out, $30.50 is at $14. So that might be an option that I might want to play. That's actually a lot better. I'm going to do that. Hold on. You can see that. That wasn't how it was before. So I'm going to go to my portfolio. Because this has not been filled yet, I can cancel this. So let's cancel this. Oh, I got to verify my account. Yeah, because that 2-week option was not there. So I'm going to go to sell. I'm going to sell a covered call, $14. Sell, call, continue. Now, I'm going to sell 1 contract of this. We could talk about the bid-ask price. So the bid-ask price, if I want this fulfilled, I can go down to that. The closer you are to the bid price, the more likely it's going to get fulfilled quickly. Right now, this isn't a huge spread, so I can go to 14 cents, boom, review order, submit, and we'll see if that gets, right now it's just placed, it has not been fulfilled. If it does, I'll receive a $14 premium. Sweet. So on 2 weeks, I just made an extra $4 on AT&T if this gets fulfilled. So as you can see how I just canceled one. If it hasn't been fulfilled, just ask for a premium that's closer to the bid price. That's all. If you place an option close to the ask price and it's not getting fulfilled in a couple hours, cancel it out, relook at what the premiums are, and then maybe ask closer to the bid price. That will raise the likelihood of it being fulfilled. While I'm on the screen, guys, we can see that all of the prices are green. So sometimes these are going to be green, red. Let's go to a different one. I'll show you one that might be different colors. Wells Fargo, trade options. This chain might be different colors. Nope, everything's here. I'll find one, I promise. Okay, so for here, Realty Income, if we look at this chain, we see some reds and we see some greens. What does that mean? Well, like we just saw, premiums are going to fluctuate throughout the day. The red and green really just represents if that premium has gone up or down. To be honest, I don't really pay that much attention to it, but that's the reason why some of them are red and some of them are green. To finish out these questions, what happens if the share price hits the strike before expiration? In my experience, I've never had a contract that was assigned early, even if it met the strike price before expiration. Then again, I'm really only doing 1 to 2 week options. You will get assigned early, more likely the longer out that expiration is. But if it does hit the strike price before expiration, that buyer can exercise that option and either call those shares away from you or force you to buy those 100 shares. If it goes above the strike price and then later in the day dips below, that upper strike price does not hold any value. It has to be above the strike price at the time that is either assigned or at expiration. In Robinhood, if the price is above for a call or below for a put, it will automatically do this at the time of expiration. The buyer does not need to do it. So you are pretty much at the mercy of the buyer as the seller. You can buy to close your own options, but as far as it being exercised, that's all on the buyer's discretion whenever it is either above the strike for a covered call or below the strike for a cash covered put. With ex-dividend dates and dividend dates, guys, I made a video about how I almost made a mistake with that. If you have an options contract that is open during the ex-dividend date, if it is assigned before the ex-dividend date, you lose those 100 shares, they get called away, you will not receive the dividend. But if that stock's ex-dividend date is, say, Wednesday, and it's now Thursday, and the option has not been assigned yet, you will get paid for those. During the time that the options contract is open, you still own those shares. So if the ex-dividend date is during the week before expiration, you will indeed get those dividends, even if it is called away on Friday at expiration. After making that mistake, I tend to avoid options during the week of ex-dividend date. Just makes things a little bit screwy. People are being a little bit more volatile. So I just kind of avoid that week, no big deal. Here's the whole playlist on the wheel, including those specific covered call and cash covered put videos. Down here, I will put my entire dividend portfolio this year. You can see exactly where it's at. And until I see you on the next one, guys, stay positive, work really, really hard, always be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.